Welcome to the Investors Trading Academy Economic Calendar of the Week. Each week our news analysts review the upcoming economic events that you should be monitoring. Global central bank rhetoric really has been the driver of the S&P 500 and all of the major indices. The Bank of Canada and England will deliver their respective interest rate decisions, which will certainly have an impact on the market as monetary policy actions have been driving the markets. In addition, several Federal Reserve speakers will be making presentations on the economy across the US. While the Fed is not delivering any policy decisions this week, their commentary is picked apart by traders, analysts and economists for clues into future moves. Economic data such as employment and manufacturing reports does not seem to move the needle anymore as long as central banks remain accommodative. After a quiet period post-Easter, there is plenty to animate markets and investors in the coming week. Firstly, China data makes a return with GDP and CPI figures both coming through. Fears about a slowdown in this economy have eased of late, but investors will want to see continued improvement if old fears are not to resurface. The week kicks off with Chinese data on consumer and producer prices. Producer prices are down 4.9% over the year, while consumer prices are up 2.3%. That said, there are some key data to be aware of in the US, including March retail sales, producer price index, industrial production, and crude oil and natural gas inventory levels. Alcoa kicks off the unofficial start of the earnings season, followed by the big banks on Wednesday with JP Morgan Chase. Heavyweights Bank of America and Wells Fargo report on Thursday, followed by the Citigroup on Friday. Not only will we be listening for the individual earnings results, we also want to hear what management has to say about the current state of monetary policy and their ability to grow earnings in a low interest rate environment. Typically, banks perform better when interest rates are at a higher level, as it allows them to grow margins at a better rate. The biggest wild card is Citigroup. Not only has the nation's fourth biggest bank by assets already disclosed that revenues from trading and investment banking will drop by double-digit percentages compared with the first quarter of 2015, but it's also said that they will take a $400 million restructuring charge. The latter is tied to its ongoing efforts to streamline its operations and focus them around global consumer banking and its institutional clients.